Peloton, one of the worst performing stocks over the past year, is witnessing a minor resurgence of late. Over the past 5 days, the stock is up a hefty 48%. Such a magnitude of price appreciation in most stocks would have been a cause for celebration for their shareholders. Not necessarily for Peloton's long-suffering shareholders, with its share price still down a massive 73% compared to a year ago. Now, you might not be aware that Peloton is also one of the most shorted stocks in the US market today. Is this latest resurgence a prelude to a possible short squeeze moment for Peloton, just like what happened to meme stocks such as AMC and Gamestop back in early 2021? We will explore more of the Peloton drama in this video, and do stay on to the end of the video as I will unveil 3 high-quality stocks that are highly shorted by the market that could actually witness a massive short squeeze in the coming weeks. Let's go! Hi guys, this is Royston and welcome to another episode of Financial Tidbits here on the NOF YouTube channel. Do remember to hit the subscribe button if you enjoy the video content on all things finance. You probably heard of Peloton as the must-buy stay-home stock to own, and if you have bought it back in 2020 and held on to the start of 2021, you would have been laughing to the bank. However, in the past 1 year, the stock has hit a massive rock wall as its operating environment collapsed amidst reopening efforts that reduces the demand for its home exercise bike, as well as embarrassing operational hiccups associated with its bike and treadmill production. Its share price recently collapsed to a low of $23 per share sometime in late January this year, after CNBC ran a news report that it will be temporarily halting its bike and treadmill production due to low demand. Then, a slew of positive announcements came which helped stem the price decline. First up, Blackwell's Capital, which owned a stake of less than 5% in Peloton, was fed up with the company's laundry list of failures and hence wrote a letter addressed to Peloton's board to implore them to fire its CEO, John Foley, as well as consider a sale to companies like Apple and Nike. Shortly after, reports emerged that Amazon and Nike both want to buy up Peloton, with Amazon potentially seeing the acquisition as a good fit to expand into the health and fitness space, while Nike might wish to kit out Peloton's instructors head to toe in Nike's attire. Peloton's share price popped 30% after the potential acquisition news surfaced. Then, to put the cherry on the cake, CEO John Foley announced his resignation after firing 2,800 employees in an attempt to cost cut. His departure resulted in the price of Peloton appreciating another 30%. While shareholders are rejoicing, there are likely 2 stakeholders that are not. First is John. Imagine you resign and the market cheered on your resignation by sending your company's stock price up by 30%. How would you have felt? Likely not over the moon, and you still have got to force yourself to say that your replacement is someone whom you admire and respect, and he is the best man to help right all the shit that you have created. Definitely not your speech of the year. The second stakeholders are the short sellers. You see, 12% of all Peloton stock is currently being shorted, meaning some investors are selling its shares to others in hope of buying them back at a lower price later on. In short, they are betting Peloton's share price will fall. But now that their bet's been proven wrong, those short sellers might be forced to buy back before their losses climb even higher. Move that will push up Peloton's stock even more. That is a short squeeze in effect. Companies whose shares are heavily shorted might witness a short squeeze effect that will drive up their share price very rapidly in a short period of time. Think of companies like Gamestop and AMC, which are all heavily shorted companies in the past, and when the trigger happens, likely a corporate announcement, the stock might fly to the moon. Most of the time, however, that rocket collapses before you even exit the Earth's atmosphere though. Now, I'm not implying that Peloton's fundamentals have improved solely because of the resignation of its incumbent CEO or for the fact that there are rumors of interested parties acquiring its business. Its business is likely still in the dumps, but a short squeeze on Peloton could continue, particularly if there is a confirmed bid from either Amazon or Nike or even Apple to buy over the company. Putting on my trading cap, if I wish to make a bet that Peloton's share price could continue to benefit from a short squeeze effect happening, but I'm still concerned over its fundamentals and don't wish to raise a huge amount of capital, what can I do? I'll seek to purchase out of the money call options on Peloton. Buying call options is a way to take a leveraged exposure on the counter while yet at the same time ensuring that my risk is limited to the premium that I paid for it. I bought all of the money options on Peloton with a strike of $40 per share, expiring in January 2023. My cost outlay was $745 per contract and currently it is worth $925 per contract, a 24% ROI over a few days work. Not too shabby. And even if Peloton's rocket fuel runs dry and it comes crashing down back to land before it reaches the moon, I know that my maximum risk is just $745 per contract, which allows me to sleep like a baby at night. I will update my viewers moving forward on how this trade on Peloton pans out in the coming months, so do stay tuned to that. Now, there are currently 3 decent stocks in my watch list that could potentially benefit from a short squeeze effect. Let me briefly run you through how I screen out for these candidates. I use the Stock Rover screener to screen for stocks with a high level of outstanding shares shorted. Anything more than 10% is considered high in my view. Next, I look at the short interest ratio, which is the number of days required to cover back all the shorted stocks based on the company's recent trading volume. The higher this figure goes, the greater the chance of a massive short squeeze happening. And lastly, I also refer to where its price is currently trading versus its 52-week high. Highly shorted stocks that are trading near their 52-week high could witness an explosive short squeeze as short sellers scramble to buy back shares when the counter breached its 52-week high, in anticipation of their price momentum getting stronger. 3 heavily shorted stocks fit the above descriptions and are also ranked very well in terms of their quality nature by Stock Rover. They are Qualis, ticker QLYS, Magnolia Oil and Gas, ticker MGY, and Allscripts Healthcare, ticker MDRX. These stocks, while sporting a market cap of more than $1 billion, are still flying under the radar compared to stocks like Peloton. Investors and traders alike who are serious in getting an edge over their peers should definitely sign up for the Stock Rover screener to uncover these gems. I have put in a review write-up on the Stock Rover platform in the description below. One easy way to potentially play the short squeeze on these counters while yet reduce your risk exposure is to purchase call options on them. As long as you are comfortable losing 100% of this outlay, which could be as low as a few $100, you can sleep well like your baby at night. We have come to the end of this video. Do like and share this video with your mates if you have learned something new and you'll like more videos of such content. I will be updating my progress on my Peloton trade with NOF viewers, possibly in the coming weeks. Do note that I'm not a financial advisor and this video is done solely for educational purposes and not meant as a recommendation to buy or sell any of the counters highlighted in this video. Please do your necessary due diligence. With that, this is Royston signing out.